Right, everybody. Welcome to the Real Estate Investment Education Club at Intel. This is a club where we get together and learn from experts in the industry who have built their real estate portfolios or have innovative techniques for acquiring cash flowing properties. Today, we are going to be talking with the founders of Avestor, who are both Intel, or several of the people, I'll let them introduce themselves, are Intel employees. So it's always good to get Intel employees as the guest speakers in the Real Estate Education Investment Club. A couple of quick announcements before we get started. First of all, welcome to the Real Estate Investment Club 2.0. We have a new SharePoint site, a new video portal site, a new meetup.com site's not new. We've been using it for a while, but also our Yammer site. And I know a lot of you have been moving over there onto the Yammer site. I see there's a little over 400 people there in that particular outlet. So feel free to post there. If you have any questions about real estate or how to find a local agent or just other questions, not for the people that are hosting it or the guest speakers, but also for the audience. It's a community, and we hope that this area will be used as a community area. The next quick announcement is, as everybody knows, on this call, we've switched to WebEx. And so there will no longer be any Skype-based sessions. I'm in the process of switching over the email announcements that I send out to the presenters, as well as Badri updated me. He had an automated email sent to him with a Skype link. So just know that the Skype is no longer being used. We're using WebEx going forward. And next week, we're going to have our first local market update. And this is going to be done by Andrea Duane, who is an agent within the Folsom community market. And so we're going to get an update on Folsom, California. And she's also said that she'd be willing to talk about the Bay Area, California as well. She seems like an extremely informed and very passionate person. So I'm looking forward to next week's event where we get our first local market update. And then next, our Voice of the Investor segment. So this is where people, if they have a short story, 3 minutes or later, can write in, and we'll put you in the middle of the meeting just so we can build a little bit more community and hear more stories from the attendees. We're going to move this over to the discussion group, which has not been happening with any great regularity so far. But we're going to start making this happen on Tuesdays at 11:30 PDT. On a regular basis, and the Voice of the Investor time will be there. It's just a time for us to get together and talk about whatever real estate questions are on our mind. As always, thank you to the NextGen Professionals Network for hosting this group. They do a fantastic service in connecting us together with Intel HR. Last week, they helped us get a couple of advertisements out on circuit to promote the club. And just a huge thank you to Dennis and Ryan, and to all the people over there that are helping us out with our internal communications. And then lastly, I wanted to share a personal story. For the last 3 weeks or so, I've not been feeling very well. I've actually had an injury to my SI-L5 joint, and I've been bedridden for the past 3 weeks and on painkillers. And so it's been a rough 3 weeks for me. But on the other end of that, this is one of the reasons why it's great to invest in real estate with a team. So even though I was in bed and bedridden and I was calling in from my phone, our team managed to close on a 145-unit apartment complex in Fort Smith, Arkansas. We've been working on this particular deal since about January, and the timeline had lapsed quite a bit with COVID complications. But we got the deal done, and it's going to give a great return to our investors. Now we're moving on to the asset management portion, where we're actually starting to improve the property, turn over the units, and managing actively while we boost the income. So I just wanted to say, I just wanted to relay that news. We also have another opportunity that's coming up. If you're interested in being an investor partner or just talking to me about any real estate related questions, I'll drop a link into the chat window, and there's a form you can sign up to get in contact with me. Or you can just email me through, that's fine too. As always, if you have any questions for Badri and Chirag, You could type them into the chat window. I'll be moderating and checking the chat window. If the speakers don't mind being interrupted, you could also take yourself off mute and ask questions. One thing that I think that the leadership team discussed this week was to limit the number of questions that a particular person can ask to 2 questions. So we don't get one person tending to ask a lot of questions and monopolizing the time. So please, if you could, limit yourself to 2 questions and think about them and make sure they're the questions you want to ask. So with that, I will hand it over to Shro and Badri with Avestor.
Hey. Perfect. Thank you, Daniel. I'm going to go ahead and share my material here. Let me know if it paints okay.
Okay.
You able to see this okay?
Yes.
Awesome. Perfect. Let me move the panels out. Great. Good afternoon, everybody. Thanks for taking your valuable time and joining us today. Our topic today is real estate portfolios. I'm Chirag Shah, and along with me, I have Badri Malur. And between the two of us, we are hoping to share some of the basic building blocks and considerations in building a portfolio, a real estate portfolio. But before we begin, I'll do the standard disclaimer, right? That the views and the information shared and expressed during the presentation are of our own, based on our personal and business experience. They do not reflect or represent views of Intel Corporation. So a quick introduction about Avestor. Avestor is a real estate platform where investors build custom portfolios, those which are diversified across states, property types, and timeframes, with 2 objectives: passive income and capital appreciation. This is our core team. Sanjay Vora and I started the effort about 2.5 years back. We joined us earlier this year. We've all 3 have had our share of high-tech background, and all have also spent several years of our personal investing in real estate. And we have a mix of exposure in terms of different types of real estate. Today's agenda is about building a real estate portfolio. Right? And what we'll do is we will talk about the building blocks of the portfolio, the types of real estate deals that ideally should be in your mix or considered for your mix, the regulation requirements around them, right? What are some of the considerations that you can take when building your portfolio? We'll also touch a little bit on crowdfunding and how can crowdfunding be leveraged to accelerate your portfolio building objectives. And then we'll end with some final thoughts. So that's kind of the agenda. So I'll begin with the data point. This is interesting. Tiger 21 is an organization of about 750 people with at least $10 million to invest. And then 30% of their assets are invested in real estate. You can see that's the biggest chunk of their portfolio. It's an interesting data point. And these are the ultra wealthy. They were the CNBC acknowledged that it's real estate remains the go-to asset class for ultra rich. So what that tells us is that the ultra rich, have made the transition from a typical starting portfolio of cash and stocks and bonds to they've made the transition to the right side here, where the pie is there's a good big chunk of real estate pie. But this audience is either many of you are quite familiar, and some of you are getting into that space. Is that investing in real estate is hard. What typically people do is they look at purchasing a property, right, with a huge percentage cash down, 20-30% cash down, taking some debt. They go to the property management, and that's where most people begin. Some people go, with the REITs route. They want to go a little bit less managed, right? And then there are advanced folks who also get into syndication deals. All of these options are great starting points, but they are hard. It's not easy to do. You have to invest time, capital, right? Risk. Now, if individual types of deals, investing in a type of deal or a type of real estate is hard, imagine building a portfolio of these is obviously harder. When you look at the building stock portfolio or bond portfolio, typically we don't have problems today. There are so many advanced tools. The investing is so simplified. Every financial advisor you go to, talks about diversification, right? I mean, there's no financial advisor who will not talk about diversification as their primary strategy. And when diversification itself tells you that there's something about portfolio that comes in play there. So with real estate, the problem is, okay, if I have to start building a portfolio, I'll think about how do I find all the real estate investment opportunities? Who should I, where should I begin? I have to analyze each and every deal. There's no public information. I have to generate confidence myself. There are complex legal documents that I should be able to read. I should be able to evaluate the financials of it. There may be high minimums for deals, so I'll probably quickly run dry if I have a limited capital to deploy. I just not being, there's no easy way to figure out the liquidity in terms of, okay, how will I plan for my next 5 years of liquidity across all these assets that I would build a portfolio for? And then how do we plan for tax ramifications, right? So all these questions come to play when I'm thinking about building a portfolio of real estate. So what we'll do today, what Badri and I are looking to do is, we are hoping to give you a basic overview. What are the basic building blocks of real estate? And we will touch each of these building blocks separately, and then from there we'll go into the top considerations, right? So I kind of briefly touch this. The real estate deals that typically make up a real estate portfolio are individual properties, REITs and funds. You can invest in equity deals, or you can invest in debt deals. Okay. Let me know if I'm going too fast or too slow, and I can, or if you have any questions, please feel free to interrupt me, or you can type it on chat, as Daniel has said already. So we'll touch each of these. Direct property purchase, this is the most straightforward. I'm assuming majority of you know this, but I'll just briefly touch anyways. This is where you're purchasing a second home or a small multi-family, 2 to 4 units. You're putting 25% roughly in that range, some good percentage cash down. You get the loan, bank loan for the remaining percentage. You manage the property by yourself, wake up 2 a.m. to fix that faucet for your renter, or you have a property manager. You generate passive income and appreciation, right? And you exit investment on your timing. This is the best part about this, is that you have full control of asset. You make all the decisions. And another nice thing, renter pays down the mortgage plus passive income, right? And you do get the tax benefits of depreciation and write-off expenses. Cons are significant cash down. That money is in the backyard of that property. Debt burden, right? There is local market risk. Typically, people invest in the same market, probably 5 miles from your zip code as primary home. You have to manage the renters, property issues, right? And there's no liquidity on the invested capital. When it comes to REITs, there are 2 types of REITs: public REITs and private REITs. Public REITs, many of you familiar, they're available on stock market, right? Some REITs are generic, some REITs are towards a specific objective, whether it's hospital, whether it's hotels, it's public storage, right? Depending upon their focus area. And so you can find plenty of information on this. So since they are available on stock market, they are highly liquid, they are easier to research. The capital requirements is very low entry point, right? You can try it out, and you should if you are interested in building a portfolio. But you will see that there's less transparency. You have to go through the prospectus, all the detailed prospectus, to understand, okay, where is my money going? It's still tied to stock market and the emotion, right? You could just see the last 6 months of REITs behavior. And there are tax benefits, some very, very few tax benefits though on the dividend payout. So that's the public side of the REIT. There are private REITs, and that's funds. Those are available through. Was there a question? Oh, okay. They are available through brokers or through directly, right? Now you can these funds are typically exempt from SEC registration. We'll talk about that in a minute here. So hold on to your questions around that. But these are independent of stock market. There's a little bit more transparency because you're going through your broker. You can ask all the questions. These are deals that are not available typically through public REITs. So these are specialized deals that maybe slightly better research deals, right? Potentially higher returns. And the last 2.5 years, we've seen the advantages of ourselves firsthand, the advantages of having a limited partnerships tax structure. I mean, the tax benefits are great. The way the structure can work, it can bring tremendous benefits to investors. It does require investor research, and there is still the liquidity, con that you have to face. once you're invested, it's depending on the type of the deal, it could be months to years. Right? Equity deals, right? Many of us typically don't easily get access to equity deals. These are large commercial deals, apartments, offices, hotels. The sponsor is typically a general partner who manages the project. Investors are passive; they receive equity stake, which is a great thing. And sponsors and investors, they have a share in income and profits, right? So the best part about this is you have an opportunity to have a stake in commercial property, which is great. There's a high in why, because there's a high overall return potential, sometimes from 15% to 27% IRR, great return. I mean, to 26% was like, about 20 years back when I used to invest in some trusts funds, which was the last time I saw that as a promised kind of return, a target return. Passive income, like, it's depending on the type of project, you can get passive income here, and sometimes they're all sort of back-ended. Sometimes you do get passive income. The tax benefits are similar to owning real estate directly, which is again a great advantage. Cons is again minimum capital per deal. I mean, that's really low. Typically, it's even higher than this, 25K to 50K. No liquidity. When you talk about equity, whenever you hear the word equity, it's about 3 to 7 years investment, right? That's the expectation that you should have. Limited, I would say no to limited pretty much. GP has full decision authority, right? And first lien is with lender. So this is where, the lender takes away, they have the first lien. So this could result in a full loss of investor capital if it doesn't perform, if this deal does not perform as planned. Okay, moving on to the debt deals. These are small to medium-sized deals, single, multifamily. I mean, this is, here you are becoming an owner, right, of the property, right? Your mentality is that in the equity side, you're trying to become the owner, a partial owner of the property. So that's why you're getting a share of the income and the capital appreciation both. With debt deals, you are a banker. You are loaning your money to somebody who would like to do a project, whether it's a single, multifamily, small commercial project. And so you obviously are not entitled to any capital appreciation, but you get your share of interest that the person that's eligible for, right? So borrower is seeking short-term funds. You basically are the holder of the note, right? You have the first lien on property, which is great compared to equity. But you receive fixed interest, right? The upside goes to borrower. More liquid. We've seen short-term the debt deals that mature from as quickly as 2 to 3 months, depending on when you enter that deal, to up to 24 months. Our investment, our experience has been in that it's in that 6-7 months many times, most of the times. So it's great to have this as part of your portfolio. It gives you the diversification. It meets some of your liquidity needs. The targeted returns here are 6 to 11%, but I'd say between holding your cash in a CD and investing in stocks, what do you have in between? For parking your cash, great option here. There is downside protection because of usually this is first lien, right? And especially if you are smart enough, making sure that typically the requirement is 15 to 20% borrower cash, but if you should do the diligence and make sure that the borrower is indeed doing that, right? Passive income is generated depending on the type of project, right? But this is really the fixed interest. Now, borrowers may have limited history. You have to be careful there. Income is considered interest income, so no tax benefit. Foreclosure processes can tie up the capital up to 24 months in worst case situation. This is my last foil on regulation before I turn it over to Badri. So there is res regulation. This is very important, right? And so pay careful attention when you're doing investments, right? So SEC is regulating all types of security. You need to understand the definition of security. Whenever you are in any sort of a profit sharing agreement, that comes under the definition of security. So now real estate deals where a sponsor is actively raising funds from passive investors and those investors receive a share of the income and the profits, that is a securities arrangement, right? That deal must be registered. Now, there are many real estate offerings that use SEC exemptions so that you don't have to register this deal with SEC. Those are called Reg D exemptions. There's a lot of regulation around this, right? Now, that's great, right? Now participating in these exempt deals is generally limited to accredited investors. So that's the part you need to know, that, okay, whether are you participating in an exempt deal or non-exempt deal? And then if you are participating in an exempt deal, am I an accredited investor or not? It's a great certification to have in today's world. And as of July 2020, it has become even easier to get this certification, right? So there are three pieces of criteria that sort of certify you as an accredited investor, right? One is based on your income. If you're an individual income earning more than $200,000 plus in the last 2 years, or as a joint family income of 300,000, plus income, that's easy. You can go to a CPA, or there are these in real estate. There are these certification online facilities. You could go to an attorney who can certify you. It's just based on that. Then there is assets, right? If you have your joint net worth that's over $1 million, not including the equity in your primary home, right? You have to exclude that. That's the only exclusion. You can include everything else. That's $1 million. That's great. You can get a certification that, hey, you're an accredited investor. I mean, the goal here is that SEC wants to make sure that you are an educated investor. You know how to take risks, and you're able to bear the risk, right? And so that's the criteria behind this. This last criteria was just added recently in July of 2020, where you can actually take an exam, and if you don't meet some of those criteria, you can take an exam and become accredited. We recommend that Series 65 is your best path. If you're going this path, is an easier path to the certification versus doing 7 and 82. There's some dependencies here which you can take offline. This third party, your CPA, CFP, attorney can provide this letter very easily. There is an expiration date that you should keep track of, making sure that you're following all the compliance rules. And then if you're investing as an LLC or a partnership, then all members must be accredited. That's another rule that you have to follow. So good regulation. Yeah, go ahead.
Chirag, a question. So in which scenario do we need to worry about SEC regulation? Like,
two scenarios, right? One is if you are actually the originator of the deal, right? You are trying to do a deal with multiple investors, right? You need to know the regulations that, hey, am I sharing income? Am I sharing profits? And yes, then am I following in this definition of security, right? This is what makes us, a security deal. And if you are, so if you're an originator of the deal, you need to know about this. And if you are investing in a deal, you need to know about this and make sure that, you're following these guidance, right? And it's more about an exempt deal, right? So like I said before, if you are in a non-exempt deal, then there are all the SEC regulations that cover all the compliance aspects anyways. It's when the deal is not registered with SEC, then SEC wants the diligence to be done by the people who are raising the money and who are investing in the money. Right?
So if I may jump in here, I think I'm not sure who asked the question. Was it Amit? So you typically, as an investor, don't really have to worry about it, really, right? Because the person who's originating the deal will have to check if you're an accredited investor. So the main point that Chirag is trying to say is that there are certain types of deals which are available only to accredited investors. So getting that certification is a good thing because it opens up the possibilities of investments for you. But you don't have to worry about, am I legally doing something wrong? Because the person you're taking the money from, who you're giving the money to, will typically do that due diligence.
Yeah, that is expected of them. But in terms of, yeah. Does that answer your question?
Yes, it does. Thank you.
Okay, wonderful. Okay, I think this is where I'd like to pause here and talk about, we'll hand it over to Badri, who's going to talk about some of the considerations in building portfolio. So Badri, all yours.
Hey, thanks, Chirag. Hi, everyone. So I guess this has not been that long, but everyone take a deep breath, stand up, walk around if you like for a second. So here is the key thing. I mean, I think Chirag talked about this in the beginning, but what this seminar is about is building a portfolio of real estate. People typically don't think of portfolios when they think of real estate, right? I mean, what you really want to do is there is a rich set of principles which are used for building stock portfolios and bond portfolios, but people typically don't use that for real estate. So we want you to think of real estate also as a jigsaw puzzle, if you will. by all means, you can always start a jigsaw puzzle anywhere, right? You can even put a piece right in the middle and then start building the pieces around it. By all means, don't let this slow down your journey into real estate. Pick the first piece, but then we want you to think about what the next piece should be and what the puzzle will eventually be 10 years from now when you complete your real estate portfolio, your complete investment, right? So we want you to think of how all these pieces put together. And so there are various criteria which you should look at. And again, feel free to jump in anytime with any questions. You need to look at the overall structure of the portfolio. Let's say you're worth $1 million. You want to allocate 20% of it. How do you divide it into various categories? You want to diversify your portfolio. Now, this might seem like motherhood and apple pie, but people don't do that. If you're investing everything in a rental home right 2 miles down your road, then you're putting all your eggs in one basket, right? You want it in multiple markets, multiple types of property. And there are various criteria you should look at when you select a deal. You can't just look at the advertising and the marketing material. And then in terms of cash flow, you'll have to look at your own needs and see what type of cash flow do you need? Do you need cash flow, or are you okay with getting the cash after several years? Each situation is very different. And then you think that you don't need liquidity, but it's always good to build a portfolio where you have liquidity at different points. An unexpected event may come up in your life, and you want to have a point where you can have the liquidity you need to meet that unexpected event. And finally, tax benefits is a very key criteria, right? You want to minimize taxes. I don't think there's anybody here who wants to pay more taxes. If they do, well, thank you. Maybe you can pay my share of my taxes as well. So if you look at the portfolio structure, again, if you look at this example which I gave, let's say you're an accredited investor and you're investing $1 million of investable assets, just for as a hypothetical example. And let's say you want to target 15 or 20% of your investment portfolio to real estate. Now, real estate is not the only alternative investment. There are a wide range of other alternative investments which are there, but most investment experts recommend that you have at least 20 to 25% of your investments in alternative investments, which can include real estate. So here are some very basic, simple math. But again, we want you to transition from which property do I buy to build, how do I build a real estate portfolio that balances risk and returns? You want to have some riskier portions and you want to have some less risky portions. Some obvious ways of doing it: you could buy 2 single-family houses, 100,000 cash, and then you take the rest in debt. Or you could buy 4 private funds or REITs, put 50,000 each. REITs, of course, you can put a smaller amount. Or you could do syndication deals like the ones Daniel has talked about, and I'm sure other people have come on this real estate investment club and talked about. Maybe you put $25,000 to $50,000 in each deal. Or you could do debt deals. Not many people do debt deals. That's a relatively lower risk way of getting into real estate, where you're lending money to somebody. And you might say, boy, that sounds risky, but actually it's lower risk because typically as long as you pick debt deals where the borrower has put at least 20% down, then you don't have to worry about, you losing the money, because unless the property values crash more than 25%, you're not losing your money. So you could put as little as $5,000 in 40 different deals where you're highly diversified. And obviously you could use a combination of any of this, right? And in terms of diversification, the key thing is you want to invest in multiple types of property. You don't want to put everything in multifamily housing or student housing or self-storage. I know that Daniel has had various experts talk about different types of property. And you also want to invest in multiple markets. Now, it is possible to invest in multiple markets without a very large portfolio. Obviously, you cannot buy an individual house in each of these markets. Just as an example here, if you look at the real estate prices in Boston, Portland, and Durham, North Carolina, you can see that they have different ebbs and flows. And if you put your money in multiple markets across the US, and obviously you can think of outside the US too, but we'll restrict our restriction for discussion today for just markets within the US. You get a much more diversified portfolio where one market may be doing well, but the other market may not be doing that well. So that's the advantage of obviously investing in multiple markets and different types of properties. And selecting a deal is very, very important. I mean, I think you have to research the deal thoroughly to minimize risk. You obviously have to look at the property specifics. You have to look at what type of property it is. What is the location? I mean, is the community, is the income growing there? What's the crime rate there? What is the risk involved with servicing the debt? I mean, even if you buy a single property, I mean, you need enough rental income to cover the debt, right? And you need enough buffer. You need to take into account economic vacancy. I mean, so obviously you can't rent your property out for every single day of the year. Then look at the overall renter risk. I mean, if it's a commercial property, is it a single renter? Are there multiple renters? Is the renter base diversified? Is it essential businesses versus non-essential businesses is a question you have to ask during these COVID times. I mean, it's much safer to rent to a business like Lowe's or Home Depot than a nail salon, which might be shut down, right? So you have to look at the overall risk of the borrower if you're for debt deals. And I mean, each is a superset of the other. And then one of the things you should really look at when you do debt deals is you should preferably do debt deals in states which do not have a judicial process. What I mean by that is there are some states which are extremely tenant friendly, and even if they stop paying the rent, you have to go to court to evict them, and that can take quite a long time. So you want to invest in states which are friendly, which don't have a long court process or a judicial process. Once you start looking at equity deals, you have to, I'm seeing some questions. Chirag, if you can address some of the questions, I would appreciate it. I don't think I'll be able to address it as I go along. I will talk about where you can find some debt deals towards the end of the presentation. And there are various crowdfunding platforms, and I will talk about all of that. So when you look at equity deals, you have to look at what kind of capital stack is being used. What I mean by capital stack is there is debt and there is equity. Sometimes there is mezzanine equity. Really, a discussion of this is beyond the scope of this talk. But you have to see whether the entire deal is investor friendly or sponsor friendly. Some of these deals, the property itself may be great. Think of it like the stock. A company might be a fantastic company, but the stock may not be a good stock, right? Because it's overpriced. At the end of the day, just because the property is good doesn't mean that the deal is good for you. You have to be able to analyze the deal, and there are a lot of tools out there, and determine if the deal is investor friendly or sponsor friendly. You want to make sure that the deal is investor friendly and not completely oriented towards the sponsor, where the sponsor takes the money first. And then you have to look at the track record of the sponsor. How long has the sponsor been doing this? How many successful exits have they had? I mean, what is their internal rate of return? I mean, and what is the risk in investing in the sponsor? All this seems obvious, but I've always been sometimes in talks where people are asking, oh, does this have a fountain? What color is the property? I mean, that's a lot less important than how the deal is structured. The financials of the deals are very important. And you have to look through the legal documents, which are fairly complex, but you really need to spend the time to look through the PPMs and really understand the deal thoroughly before you invest in something. Yeah. So portfolio cash flow, but I mean, this is fairly obvious. When are you getting your money? How much money are you getting? I'm not talking about exiting the deal, but I'm talking about what is your monthly income. When you purchase a rental property, you put in some principal, you have a loan, you get some monthly income. Hopefully that income is more than what you're paying out in terms of loan payments and interest expenses. You kind of go along, and eventually you sell your house, you get your return, and hopefully you've got some long-term capital gains. That's the theory, right? In a debt deal, you can have two different types of debt deals. You loan the money and you get the interest monthly, But often in residential debt deals, sometimes the interest is not paid monthly. You get the money back at the end of the loan. Typically, the loan, as Chirag said, is between 6 to 18 months, typically 12 months is a fairly common thing. So you get, I'm talking about fix and flip loans. I'm not talking about the 30-year loans. I mean, why would you want to lend your money to somebody at 3%? The fix and flip loans have much higher interest rates, somewhere between 8 to 11%. And then the equity deal, generally, it depends on the type of equity deal. Some of them are new constructions and some of them are renovations. But generally, most equity deals have limited distributions in early years, and most of the distributions come in later years. And each equity deal has some kind of a target exit date. But remember, this is not like a CD. It's not set in stone. Market conditions may mean that the exit date is delayed. And the idea here is eventually you get your money back and have some appreciation when the property is sold or turned over in some fashion. So you have to look at all of this when you build your portfolio. Again, I want to go back to what I said in the beginning. By all means, get into your first deal. Don't worry about your portfolio. But once you start looking at your second deal, whether it's an equity deal or a debt deal, you want to think about it as in a form of a jigsaw puzzle. How does it fit? How do these pieces fit together? Do they meet your needs? It's very important you look at all of that. And in terms of liquidity, again, it's always good to build a portfolio where you have liquidity events at multiple points, as opposed to saying, I don't think I really need the money. I'm okay tying this up for 5, 10, 15 years, right? So if you build a portfolio, with REITs and funds and debt deals, then you can have liquidity at different points, as opposed to having liquidity at one finite point several years from now, right? And a well-built portfolio will provide improved liquidity, yeah? And then obviously you need to look at tax implications. So, the tax situation for everyone is different. I don't pretend to be a tax accountant. But at a high level, when you do debt instruments, typically they give money in 1099 INTs, similar to the money you get from a CD in a bank, and you get interest income. For equity investments like the syndication deals, typically you get a K1 for each equity investment. And that can result in some real estate income and loss. It may be on paper, you may have some paper losses, but eventually when the equity exits, the deal exits, you can get that back in long-term capital gains. That's one of the advantages of equity investments. And in terms of private REITs and funds, typically most of them do a 1099, but some do a K1. If you do invest in private funds, you probably should prefer a K1 kind of a deal, because then you get the long-term benefits of depreciation and long-term capital gain benefits of real estate, yeah? And so some things to keep in mind. The interest income is always taxed at your current rate. Now, capital gains so far have preferential treatment, long-term capital gains. With the new election, with the election coming up, that may change. We'll have to wait and see. And keep in mind that each K1 you get for an equity investment is treated as an independent K1, and passive losses from one investment cannot offset gains from another. So equity investments in other states may require a filing return in that state. You'll have to check the state-specific requirements. And if you're using a tax preparer, K1s, the more number of K1s you have, the higher you have to pay in terms of accounting fees. But TurboTax and Premium and Business handles K1s quite well. So don't let that scare you, yeah? So understand the tax ramifications of your investments before you proceed is the main point I want to reiterate here. So I'll come back to the questions in a little bit. Let me finish the presentation, and then I'll try to cover as many questions as possible. I don't know how many of you are familiar with crowdfunding. So previously, you could not invest in commercial real estate without having a multi-million-dollar portfolio. But the Jobs Act of which was promoted a few years back allowed individual investors to invest in deals. There are a large number of marketplaces that give investors an opportunity to invest in real estate deals. The advantage of this is you're investing in larger apartments, office buildings, retail, industrial buildings, etc. And you can build a portfolio. Remember the concept of a portfolio. You can get a large amount of diversification. And so crowdfunding platforms get paid for raising funds efficiently. And so you have to be careful. I mean, their interest is to turn over and raise money from investors as soon as possible. And again, you need to assess the quality of the deals. Don't fall for pretty pictures and marketing materials. You can't just go look, oh, this has an internal rate of return of 25%. Let me go for this deal. You have to go through the PPNs, understand your rights, and understand if the deal is sponsor friendly. Just don't go based on advertised returns. And be prepared to tie up your money longer than advertised. Often these deals, they may have an exit date, but it may take a little longer than the exit date. Yeah, be prepared for that. So here are some crowdfunding options. I know some of you were asking what type of debt deals are there. I'm trying to get my chat window so I can look here. Let me see here.
Would you like me to give you some questions?
Let me go through a couple more slides and then maybe you can give me some questions. That would be good, Daniel.
Okay.
I haven't had a chance to look at the chat window while I was talking. Thank you. I appreciate that. So, or maybe I'll finish the presentation and then we'll get into the questions. Then that way it'll keep it clean. So there are various crowdfunding platforms. You can go to Home Union and Roofstock. And for example, if you want to buy homes in other markets, I mean, these are ready-made, ready-to-rent homes. And obviously, you can go through a realtor, but there's a lot of information in one website. Or you can go to private REITs and funds. There are funds like Fundrise and Realty Mogul. By the way, I'm not recommending one or the other. I'm just giving examples at this point. And one of the advantages of something like Fundrise is non-accredited investors can also build a portfolio, but a lot of the Fundrise investments give a 1099, so you don't get many of the benefits of real estate. Yeah. Then you can invest in individual commercial equity deals. You can go to syndicators, or you could go to a place like CrowdStreet or Equity Multiple. There are plenty of deals. You can browse through the deals, but again, be aware, spend the time to research the deals. One of the disadvantages is many of these deals go really fast. Yeah. And then you can invest in individual commercial deals. Some sites which work for that is Fund That Flip, Patch of Land. And I kind of, one other suggestion I have is Ground Floor, especially if you want to invest very small amounts per loan. And Ground Floor, one of the advantages of Ground Floor is that it's open to non-accredited investors. You can invest as little as $10 per loan. Not that I would recommend you take the time to invest $10 in each loan, but the minimum is very low. Yeah. So here are a couple of examples of crowdfunding deals which have gone south. I want to allocate enough time for questions. I won't spend too much time on that. These are deals which my partner had invested in. The start date, there was a Hard Rock hotel in Palm Springs. Hard Rock, what can go wrong, right? I mean, great brand, Palm Springs, nice place. And, the IRR was 15 to 17%. And the final return was 100% of the investor capital was lost. So be aware of that. You can lose all your money. The reason was the sponsor was a very weak sponsor. He mismanaged the property, and the Hard Rock revoked the franchising rights and revoked the flag, and the lender took over the property, and all the equity people were wiped out. Here is another example: a rehab and flip. There are dozens of deals which went right. So I'm just pointing out a couple of deals which went wrong. So the key point here is diversification, right? So this was supposed to pay 10% interest, but the project took much longer. The borrower was not unable to pay the money back, and there was a foreclosure. But remember, the debt deals are a lot more less risk than equity deals. And this was one of our worst debt deals, and we lost 6% on it, which is not terrible, right? We didn't get any interest and we lost 6%. But it's not as bad as losing 100% in an equity deal. Yeah. So here are some final thoughts, and then we'll have plenty of time for questions, I think. My co-founder, he bought a Central Oregon home, and he bought it for $150,000. Was pretty happy when in Bend. I think most of you are familiar with Bend. The prices went up even more, really happy. Then they started going down. He was a bit worried. And then it went down a lot, extreme stress. And then it came back a little and he said, oh, let me get out of it. And he roughly at the price he bought it at. And then right after he sold it, then you have the regret phase, right? The prices really shot up. Couple of points I want to make. I mean, different people have different experiences, right? I own a fourplex, a triplex. There's absolutely nothing wrong with investing in a property, but be prepared to buy something which you're owning for a very, very long term. And we talked about liquidity, right? To make sure that this is that portion of your portfolio where you don't mind not having any liquidity and ride through multiple market cycles, right? And you definitely do not want to put your entire real estate slice in a single property. Not a good idea, because you're tied to the vagaries of the market. And it's much better to build a diversified portfolio. So in summary, think of investing in real estate like stocks. You build a portfolio with multiple options so that you can diversify your risk. Private funds, equity, and debt deals provide a way to expand your portfolio. And structure your portfolio thinking about your individual needs. I mean, everybody is unique. I can't tell you what's right for you. And make sure you research the investments carefully, read through all the legal documents. I know this sounds obvious, but you will be surprised how many people don't even bother looking through the PPMs. And then make sure you take into account cash flow, make sure you take into account taxes. Crowdfunding can accelerate your portfolio, but be cautious. The last thing I wanted to mention, I'm just mentioning it in the context of Avestor Inc. does provide you a very easy way to build portfolios, because with as little as a $25,000 investment, you're diversified across a large number of equity and investment deals. If you are interested in learning more about Avestor Inc., you can reach out to me. We build custom portfolios which can be diversified across multiple states, different property types. And there's a lot of information in avestorinc.com. And here is my contact information. Feel free to reach out to me. And we are all about how to help you build custom portfolios. So I won't go too much more into Avestor Inc. There are other ways you can obviously build portfolios. You can do your own custom portfolios by going into this different crowdfunding sites. And you obviously can buy a house, or you can do REITs, or you can do private funds, multiple ways to do it. So let me make sure I have enough time for questions. And instead of me going in order, I'm going to give Daniel the privilege of selecting questions. So you can blame Daniel if your question doesn't get answered.
All right. Well, I'll stop.
And Daniel, I've been answering some of the questions on the chat window.
Oh, okay.
Yep. Thank you. And just keep in mind,
sorry to put you on the spot, Daniel.
Oh, no problem. Just keep in mind also, we can't give specific tax advice. It all depends on your particular tax situation. But maybe you could comment a little bit on depreciation and K1s and how that rolls through to the individual investor when it's active versus passive.
Okay. So basically, I mean, I know this might sound really basic. Depreciation allows you to basically write off the cost of the property, not the land, over a period, which is typically 15 years, 25 years. And there are some subsegments of the property like carpet and all that you can write off much faster. So effectively, and again, this is an entire topic by itself, you might have cash flow losses. I mean, you might have, but in reality, you're making money. So you might have losses which will come through in a K1, which will help you offset losses which will accumulate. And eventually, when you sell the equity deal, then you basically get long-term capital gains. I don't think I did a very good job in explaining how depreciation works. As a passive investor, you get, if you do invest in syndication deals, you get a K1. And then you might have some losses which you accumulate, and you cannot offset that against a separate K1. But eventually you'll be able to get long-term capital gains, which will wipe off those losses. So Daniel, I don't think I did a great job with that, but we'll stop there to take more questions.
Okay. We have a question about the impact of the upcoming election. And the question is, can the viability of multifamily/syndications be adversely impacted based on the outcome of the upcoming elections?
I mean, okay, this is my opinion. Doesn't obviously reflect Intel, or maybe it doesn't even reflect Avestor or Chirag, actually. I don't think the election itself will have a huge impact on multifamily. The impact is more on whether the stimulus bill will pass and how much delinquencies, how many people not paying rent we will see, right? I mean, so there are some impacts we're already seeing. There is so much money flooding into real estate that what are called cap rates are actually going down. I mean, you're really not getting much cash because the prices of the property are going up. That's being offset by lower interest rates. So I personally don't think the impact of the election will have, the elections itself will have a huge impact on real estate. But obviously the virus and what happens with COVID will have a huge impact. I mean, if it's a prolonged season, then and a lot of the businesses are shut down, if people can't afford to pay rent, obviously it'll have an impact on multifamily. But if you are in Class A and upper Class B kind of properties, you may see a little less impact. It's a little dangerous time to be in Class C properties, to be honest.
All
Daniel?
right. Next question. How to invest in properties in other states when you may not be able to see them? Is due diligence only a paper exercise, or are we expected to do something more?
You know, that's a good question. It really depends on you, right? I mean, if you can afford to fly over and you have the time, and that's where you will pay a little extra, then you obviously want to have good realtors. That's where a place like Home Union and Roofstock, they have ready-made homes which have gone through some level of screening. It is not uncommon to buy these days, especially in the COVID era, properties without seeing it. I think if you have a good realtor who you trust, and you know, there is obviously you can look through it through a video conference. But if you feel comfortable, you really should fly over it. It also depends on the value of the property and the price of the property. If you're buying a $5 million house versus a $200,000 starter home, two different things, right? So.
So many good questions here that I'm looking. I'm keeping myself back from answering, but I'll pass them on to you. How do you distinguish between Class A, B, and C properties?
Aha, that's a good thing for a future webinar, right, Daniel?
It is. You could do quite a bit in demographics and how to distinguish that.
But... Yeah. So it's just based on the quality of the property, the quality of the clientele. I think I'll defer that to a future webinar. I mean, it's for the people are of the lower income and the rent is not as high. It's more of a Class C property. Class A, very close to premium real estate. Premium shopping malls is more Class A. Class B is somewhere in the middle. But let me try to answer more questions. Let me take a breadth first approach as opposed to a depth first approach. So.
Okay, at the moment, we don't have any other questions. Oh, here comes one. How does your company help diversify in real estate?
Okay. We can't talk too much about Avestor, but let me briefly answer it. What we do is we have built a proprietary model where we evaluate hundreds of deals in crowdfunding platforms, and then we select a small subset of them, and we offered both debt deals and equity deals, and slice them into small slices. So instead of having to invest $50,000 per deal, you can invest as little as $500 in a debt deal and $2,500 in an equity deal. That's how we help you diversify. You can even come and say, hey, we don't want to invest in Oregon, or I don't want this state. I'm not comfortable with Texas. We can take all of that into account and build a custom portfolio for you. Beyond that, I would prefer not to talk because at the end of the day, this is an educational seminar. Feel free to reach out to me. And my contact information is below. Yeah. So, one last question, maybe.
Okay.
Or maybe two questions, if you can go till one.
For the last one here. I'm considering a non-recourse loan, already cost segregated. Deal doesn't look good through normal. Deal doesn't look good, but if I factor in taxes from COVID, it might look better. Okay. Do people invest in deals with you, or do you just help people build their own portfolios?
No, we pre-screen these deals and we buy it with our own money and allocate it to people who come. So you can be a completely passive investor and you can come and choose the deals from what we have chosen, or we'll completely allocate it for you like a robo-advisor of sorts. So, and again, I'm happy to talk to you more offline. So.
Yeah, and this is Chak. I suggest the same to understand our platform. This is not an avenue that we are supposed to use, but there is a lot of criteria that we have built over the last 2.5 years that goes into both from a tax advantage perspective and obviously from our own classification perspective of classifying properties and the quality.
The one thing I would add is we do combine all of this into a single K1. That's the one last thing I'll add about Avestor, and let's take some more general questions. Instead of dealing with multiple K1s, we have built the platform to generate a single K1 for you guys. So.
All right, we have. Okay, we're getting a few more questions in now. The presentation started off on the ultra wealthy's portfolios, which included real estate. Did you see the ultra wealthy generate the wealth first and then move it into real estate, or did they leg into real estate, which caused them to get wealthy?
I think it's a combination of both. So basically, I do know, I mean, Daniel, you can jump in here too. There are several people who work for a living, have done very well in real estate and built a passive income flow, which can replace your regular job income, giving you more flexibility. And then you gradually move into the ultra wealthy, I guess. And then once you move into the ultra wealthy, real estate continues to build your wealth. So it's not either or, it's both, is what I would say.
Yeah, I would just say that people do make, if they are ultra wealthy, they make that in a lot of different ways. They may have built a business and sold it. There are many avenues to get there, but one thing that is almost universally common is that the ultra wealthy do hold real estate.
Hey, and don't mean to get into politics here, but maybe you'll have a chance to pay just $750 in taxes. There you go. That's the hook for it.
All right. Any last questions before we thank our guest speakers? All right, Badri and Chak from investorinc.com. Thank you very much for coming on and sharing a little bit about diversified real estate portfolios.
Thank you, everybody. Thanks for listening.
I appreciate it.
Thank you.